Something dark is happening in Russia. It is not on the front lines in Ukraine, but deep within the country's financial core. The state is spending money far faster than it can earn it. That simple math is now the biggest constraint on continuing the war. For all the talk of strategy and tactics, the real war of attrition is being fought with rubles. And it is a conflict the Kremlin is slowly losing. Not a sudden collapse, but a grinding erosion of foundations. Cracks too wide to paper over with propaganda. The war was supposed to be short and cheap. Instead, it became a protracted, ruinously expensive fight. Plans assumed a swift victory and intact reserves. Years in, the treasury bleeds every day. Sanctions, labor shortages, and oil strikes now feed a perfect storm. The roots trace back to 2014 and the annexation of Crimea. Conflict in the Donbass provoked Western sanctions. Moscow began building Fortress Russia, stockpiling reserves, cutting foreign debt, and substituting imports. Then, a pivot east toward China and India. Energy customers were secured in new corridors. 2022 brought unprecedented sanctions and asset freezes. Major banks were cut off from global payments. Companies exited, supply chains snapped. After a plunge, capital controls and rate hikes steadied the ruble. Discounted oil to China and India became a lifeline. Officials declared the sanctions had failed. For a time, daily life looked stable in big cities. Behind the facade, the war machine consumed more. But buffers were finite, and the bill was growing. By late 2025, the cracks could no longer be hidden. The fatal miscalculation. Weeks, not years. A short war budget collided with long war reality. Ukrainian resistance proved far fiercer than planned. Costs spiraled as fighting dragged on. Every day, salaries, ammo, fuel, and replacements. Reserves accumulated over a decade were tapped. The National Wealth Fund steadily depleted. This trajectory is not sustainable. They are burning through savings to fund the present. The safety net Fortress Russia promised is fraying. Industry shifted from civilian goods to weapons. This inflates GDP while starving consumers and investment. Sanctioned tech now arrives via costly gray markets. Russia pays a premium for every critical component. Delays and uncertainty ripple through production. War under isolation makes everything harder and pricier. For decades, oil and gas funded Moscow's state and military. Ukraine exploited that reliance with long-range strikes. Waves of drones and missiles hit infrastructure. Refineries, depots, and terminals were struck. Deep inside Russian territory, physical damage forced shutdowns and slowdowns. Domestic fuel shortages spread and prices spiked. Exports were curbed to protect the home market and military. But that cut foreign currency earnings. Fires became a symbol of the war coming home. Reduced refined products squeezed logistics and agriculture. Crude still moved, but higher value products fell. Repairs are slow, costly, and hindered by sanctions. Air defenses cannot protect a vast network end-to-end. These strikes impose direct costs sanctions alone could not. The industry meant to fund the war is now a battleground. Beyond money, Russia faces a worsening labor crunch. Hundreds of thousands killed or wounded. Prime working age. Mobilization keeps pulling men from factories and farms. An exodus fled conscription, repression, and the war itself. Skilled IT, scientists, doctors, entrepreneurs left in droves. The brain drain is hard to replace. Construction, manufacturing, transport, agriculture, all short of staff. Wages rise, but inflation eats purchasing power. Higher labor costs squeeze margins and stall investment. Even loyalists admit labor is choking growth. Moscow courted migrant labor, with limited success. A weaker ruble and social strain deter arrivals. Every soldier sent is one less worker at home. This slow-acting poison degrades capacity month by month. Recovery without people is impossible. The Kremlin can print rubles, but not workers. Monetary shock therapy raised rates to fight inflation, but high borrowing costs strangled the private sector. Capital controls tried to prop the ruble and halt flight. They buy time, but erode long-term confidence. Signals to investors: assets can be trapped. Fiscal gaps grew as war costs mounted. Taxes on the wealthy and profitable were floated as fixes. It warned elites to contribute and soothed public anger. Justified with wartime precedents abroad, money printing fuels inflation. High rates choke growth. Controls corrode trust. Taxes risk stifling investment despite controls. Reserves and oil prices are no longer enough. The economy drifts in managed decline. Options narrow. Squeeze harder, or scale back the war. In the end, the balance sheets may decide more than the battlefields.